I'm a big believer, as you know, if you watch this channel, I still think it's misrepresented a lot of times. This video is a flat out freaking lie. You follow this advice, you are putting your entire personal financial world at risk. You shouldn't use IUL for infinite banking or real estate investing because of what I'm about to show you. Hey, what's going on, Cashflow hackers? It's Chris with Life 180. In this video, I'm going to be doing something that I've been wanting to do for a long time, which is break down a lot of the bull crap information that's going on Instagram, on TikTok about Index Universal Life. If you hear me talk about this, I think it's our job to educate, not market to. A lot of this information that's happening on TikTok and Instagram Reels when it comes to using short form content to kind of mislead people about the power of life insurance in general, right? Like I'm a big believer, as you know, if you watch this channel, of whole life insurance and how it can be used. I still think it's misrepresented a lot of times. But what I am really passionate about is educating people about how to reach financial freedom. And the problem is there are so many people online, thousands and thousands of people online now trying to be influencers, trying to create content, misleading people about Index Universal Life. It's one of the reasons I'm writing my new book, IUL Exposed, the truth about the most misrepresented product in financial history. That's why I'm doing this. Now, that said, what I want to do in this video is I saw a video and I'm going to react to this video, and I'm not going to just react. I'm going to educate. I'm going to show you why this video is a flat out freaking lie, and why if you follow this advice, you are putting your entire personal financial world at risk. I always say you cannot use infinite banking or real estate investing. I should say you shouldn't use IUL for infinite banking or real estate investing because of what I'm about to show you. So if you've thought about it, if you are somebody who sells this, I really encourage you to do your research, take the information I'm going to give you today and dive deeper. Ask the critical questions and realize you should not be falling for these scams online. And so without further ado, what I'm going to do is there's this guy, his name is Money Mythbuster. I'm going to share the screen. His name is Money Mythbuster. And he's got this thing. You can see his comments here. He just released this video. For the record, he's got like 160,000 followers on Instagram, which is impressive. He's got 2,336 posts. So he's super active. He creates a ton of content. Full transparency, he and I have had a little bit of a battle and a debate for, not a debate because, I've challenged him to a debate and he says I'm the one dodging him. He's also claimed that I've eliminated and deleted his posts off my TikTok channel, which has never happened. And so I can't wait to see his response to this. So I'm going to play this. And as we go, I'm going to pause and focus on certain elements here. So let's go.
Second year, they want to take out $1 million. Okay.
So what he's showing is you put $1 million in. Actually, I'm going to play the whole thing and then I'll go back and I'm not going to react. I'm just going to let you watch it. And then I'm going to go back and I'm going to react and educate to the information that he talks about.
Buy property, buy whatever it may be. As you can see, their account value is still growing. They never took the money out of the account. They're borrowing it from the life insurance and from their surrender value. In year 6, they take out another $3 million to go buy more property. As you can see, the account value is still growing in the account. Year 11, another $1 million out, growing still $7.1 million. And after they're done buying property and decide to retire, they put all the money back that they've pulled out, and they're going to take $1.9 million of tax-free retirement for the rest of their life. That's $71 million.
So
people don't get this for the life
if you think that's possible,
insurance. They get it because you can use the same dollar twice for infinite banking to be able to cash flow yourself instead of using a bank. Banks already do it.
Banks. First of all, banks don't do this, y'all. Banks. I'm gonna pull this back up at the very beginning of his video here, and I'm gonna go back through this and download it. But what I'm gonna tell you right now is that banks do not use IUL. Banks have been doing this. A lot of IUL agents like to talk about banks utilizing life insurance, and they try to position it like it's IUL that banks are using. Banks have been doing this strategy far longer than IUL has even been in existence. Banks, if you want to use common sense, just go try to get what's called the cash value line of credit from a bank. They'll do it for a whole life insurance policy, and they'll give you 95 to 100% of your net cash value for a line of credit against your whole life insurance policy. When you go do it with an IUL, either the bank is going to say, no, we're not going to do that for you because of the fact that It's too risky and we're just not going to do it for you. And so if a bank wouldn't lend you money to collateralize the asset, why would they do that for themselves? Just use common sense. And then secondly, if they would do it, they're not going to give you 95 or 100%. They're going to give you the most I've ever seen a bank be willing to do for a line of credit on the net cash value of the surrender value of an IUL is 70%. And so when you really break it down and look at it like that, you start to realize like, oh, it just takes a little bit of common sense to break down and realize banks are not doing this. So it's kind of BS. And now, so what I want to do is I want to go back into this and I'm going to play this through one more time and I'm going to pause it at the relevant places where I think you need to kind of see it.
To a life insurance policy, why would anybody ever do that? Let's take a look.
All right.
This person's actually going to put in $5 million over 5 years.
He's talking about doing $1 million for 5 years. And that's it.
Okay.
And in this world, like, think about how absurd these expectations are. You're going to put $5 million in for 5 years and then take 1.9 million a year of income and be able to use the money along the way. If this were possible, I would put every dollar I've ever owned into it. And I can see why he's got 162,000 followers, because there's a lot of people that have followed him foolishly because he's misleading people. And this is just, it's lacking so much factual truth. And this is the problem with 60-second content and people making decisions that are some of the most important financial decisions of their life off a 60-second piece of information. So here we go.
So as you can see, $1 million for 5 years. They're all.
And you can see $1 million year 1, $1 million year 2, all the way through year 5. He's put $5 million in where he is there. He's got $1 million loan that he's taking out in year 2. And you can see the loan balance at the end of year 2 is $1,050,000. That means it's a 5% loan rate. I don't even have to look at the illustration to figure that out. That's pretty simple math. He's taking a 5% loan rate. So you know the interest crediting on the loan rate is, or the interest expense is 5%. And with this, they're earning a 50 basis positive arbitrage on the illustration. So there's a couple key factors when we look at for the illustration. I'm going to go back here, stop sharing this for a second, and I'm going to cut to here, and I'm going to do a little education here. So there's a couple factors that go into this. When on an illustration, they shows no down years, no negative years. That's the problem. And then the other thing is it shows 50 basis points, bips, which is 0.5% of positive spread or arbitrage on every single year. So in this illustration, it's going to show you every single year is positive, and it's giving you're borrowing at a certain percent, and on the even on the years that you're borrowing, you're earning more credits than you are in loan expenses. So for instance, if in this example, he's taken $1 million loan, then we have the loan balance. And so what will happen is it goes $1,050,000. I'm just breaking this down for you because he didn't show you the whole illustration, but I want to break it down for you. And then I don't know if he showed this on the illustration, but he's got loan credits, and the loan credits would be 1.55. So it would be $1 million. It would be $55,000 in credits, basically. So it would be $55,000 in credits because, and the idea here would be you're making this $5,000 extra in credits than you're paying in loan expenses, and that's how the compounding of this works. But I always say life doesn't exist on a spreadsheet, and you got to be really, really, really careful when you're doing this stuff, because when you look at it like that, it looks really attractive on the illustration, but that's not how it actually works. So let's keep going here, and I'm going to break this down even further for you. Let's go.
Well done. Now in the second year, they want to take out $1 million. Okay, buy property, buy whatever it may be.
I was just showing.
As you can see, their account value is still growing.
Okay, so you can see this. The account value is still growing, but you see the accumulated value of, you know, and by the way, he designed this policy fairly well for an IUL as far as like how you can actually design it. But what we're doing here is we're showing the real risk. So take a look at this. The loan amount typically, because this has got surrender charges as well, so it's a little awkward. What I want to do is I want to get to the end here. Let's just assume, well, let's look down here, because remember at year 6, I'm going to write a couple numbers down on my board here while I'm looking at this screen. It's 5,330,000 is the accumulated value. Okay, so we got 5 million. Here, I'm going to erase some of this. 5,300. 5 million. What was it? 5,330,661. And that's the accumulated value. And then the surrender value is 1,349,000 and 309. Okay. Okay. So now you can see here that, let's see here. All right, let me go back here. I'm trying to produce this on the fly, so bear with me here. So now what I want to do is I'm going to go back here again. So you can see what we have here is the accumulated value and the surrender value are there. Now there are still, because of the fact that you're in a surrender period cycle with this, one of the things that we have to do here is we have to take these and I have to minus these numbers from each other. So I'm going to go to my calculator here and I'm going to go 5,330,661 minus 1,349,309. Now I'm going to be rough on this. It's 3 million. I'm going to just clean this up a little bit. $3,981,352. Okay, this is the loan amount. Still due. Now, it's probably not quite that much because of the fact that there are still surrender charges that are going into this amount. So my guess is it's more in the $3,500,000 range because I don't have the full illustration in front of me. It's really hard to break that down concisely. But let's just say the loan amount is $3,500,000 right here. This is the actual loan amount. Let's just move with this assumption, okay? Which I think is really important to do, and I think that's probably a reasonable number, all things considered. So if the loan amount is $3,500,000 and the surrender value is $1,349,000, what you're not seeing here is, and I want to show this real quick, what you're not seeing in this is that when people are running the illustration and they're showing the positive years every single year, he doesn't talk about what happens in a negative year. All he does is shows, well, every year this is going to be positive, and it's going to show 50 basis points of positive spread. Seems really attractive, seems really sexy, but the reality is that's not how it's going to work. That's not how it's actually going to perform. What's going to happen is that life is going to happen. 35% of the time, the market is going to perform worse than 5%. Which is your cost of borrowing the loan, meaning you're going to earn less in credits than you'll actually be being charged, which means 35% of the time you're going to. What does that do? That expenses of the product, it increases the expenses of your insurance, the net amount at risk, it impacts all that. But here's where it gets worse, is the loan risk on these things is wild. They always say you can't lose money because of market risk, but you can, and here's why, because when you take loans against these things, you see this $3.5 million loan. That loan has a responsibility of a 5% interest rate. What is $3,500,000? $3,500,000 times 0.05. It's $175,000 is 5%. That's your 5% loan rate on $3,500,000. Okay, so that means if the market did zero, like I'm not even saying having a negative 10% year. I'm saying if the market equaled zero. Okay, this is where you need to understand this for IUL. If the market did zero, you have a $175,000 expense. That has to come out of somewhere. That is an extra charge that will be impacting the value of this thing. So where do you think it's going to come from? It's going to impact all of your money. The surrender value is going to cover that, okay? So you're not going to have the credits that are added to it, because remember, this is assuming, all this illustration is assuming you had all these big credits. Well, those are gone. So that means you're going to have actually less in the surrender value column. It's going to be less than by $175,000. So this 1.349. I want to go 175,000 divided by $1,349,309. You're looking at a 12.9% loss. Basically a 13% loss if I round it up. 13% loss on a 0% market year. Think about that. It's freaking insane. Yet people are doing this. This is why I say you cannot do infinite banking, because the loans compound against you if you don't manage them. And you cannot utilize this for real estate, because can you imagine if you utilize this money for a real estate portfolio and then you utilize these loans to do this, and all the while you have this big loan balance that is a massive liability, putting your real estate portfolio at risk. And now just with a 0% year in the market, you now have a $175,000 expense to manage, a 12.9, 13% loss on all this. Like, the craziest part about this is if the market doesn't even lose, let's say the market does 2%, right? You still have a market expense that goes with this, because the cost of money is 5%. So you still have a 3% expense. So 3,500,000 times 0.03, which is 3%, is 105,000. And we do that divided by 1,349,309, which is your net surrender value, which is the number that matters. So even on a positive 2% year, in this example, you have an 8% loss. Think about that. That is an effective 8% loss. This is why, like, these guys that take these videos and they make them look like they're fantastic and they make them look like the biggest no-brainers in the world. This is why regulation AG 49 was created in 2015, and then companies got away with it, because the regulation AG 49 is designed to rein in the illicit illustration activities that are put on by the insurance companies. And the challenge is, then as soon as the new regulations come out, insurance companies come out with new rules to get around it. I always kind of say, I equivalent it to, it's like the feds chasing Capone back in the day. Like, it's really hard, because these private companies are much quicker, much more nimble when it comes to navigating and adjusting. So it's important to understand, if I was wrong about this, they wouldn't be updating the regulations. They wouldn't be updating AG 49 to AG 49A to AG 49B. And they're already working on creating another adjustment, because these illustration companies, the IUL companies, keep working on ways to get around the illustrations. And it's really just illustration warfare. You can look at this stuff, you can get excited about it, but it's what you're looking at is not going to
They never took the money out of the account. They're borrowing it from the life insurance and from their...
And kind of see the numbers that he's putting out there again one more time, just to put it into perspective, because this is insane.
Surrender value. In year 6, they take out another $3 million to go buy more property.
Oh, no, loan balance. You can see 4.42 million is the loan balance. I'm even wrong. Holy crap. I'm even more wrong. 4,042,000 is the loan balance. So, like, it gets even worse. Holy smokes. So check this out. 4,042,000. Let's go back to the board here. 4 million times 5. So 4,042,000 times 0.05. $202,000. $100. Okay. Divide that by the 1,349,309. It's a 15% loss on a flat year. 15% loss on a flat year. And this is the thing, like, he doesn't talk about that. So now the next year, when we look at this, the crazy part here is, now the next year when we were to look at this, if this were to be the case,
yeah, as you can see
here. So the next year it shows he's got 1,349,000. You wouldn't actually have 1,349,000. You'd have 1,349,000 minus 202. I'm just going to keep numbers really round. You'd actually have 1,000,741, 1,147,000. But then the next year it shows you got 1,811,000 there. You're not going to have that because you had a negative year. So imagine having 2 negative years in a row in that instance. You're actually probably going to wind up with $1 million less in your net surrender value column than you thought you were going to have, because the crediting is not working. Because remember, they're assuming you're getting this positive creditation on that $5.5 million number, right? Like, so 5.5 million, just to keep numbers round, times 0.005, that's 27,500 of positive credits above and beyond the charges and expenses that you're doing. And that compounds in a really positive way. But when that doesn't happen, you don't just lose that, you lose all the other 5% as well, which is over $200,000, and it comes off your net surrender value. That increases your cost of insurance. The net amount at risk goes up. Everything in this thing turns into an absolute catastrophe. And this is one of the reasons that I tell people you cannot utilize Index Universal Life for infinite banking or real estate investing, because you got clowns out there like this guy that are trying to act like you can do it. The reality is you cannot do it. So beware of these tactics that people are using on Instagram, on TikTok, on YouTube Shorts, and beware of like them just using illustrations to try to make it look like these illustrations mean anything, because they don't. Go read, I guarantee, get that illustration and go read the fine print. It will tell you pretty much everything that I'm saying. And when you read it line for line. It's probably 60 pages long. It's like a legal document. And the reason they do this, and the reason they get out of it, they get involved in class action lawsuits all the time. They get involved in lawsuits individually all the time. And they get away with it a lot of the times because the disclaimers are in the illustration. The ledger that you're looking at means absolutely nothing. Read all the fine print and go from there. Hopefully you found value in this video. If you have any questions, comment in the comment section below. If you found value in this, please like it, share it, get it out there to people. Subscribe and hit the bell if you haven't already. That way you're notified when I launch new content. Till next time, hopefully you found value in this. Have a blessed, inspirational day. We'll talk soon. Later.